Hello, welcome to Accounting 2010 Chapter 5 videos. In video 1, we are going to be recording purchases using the perpetual method. So in Chapter 5, we are looking at businesses who serve as wholesalers and retailers. And these are businesses that sell their products for a profit, either directly to the consumer or to another business. They are not the manufacturers. You'll be learning about manufacturing in Accounting 2020. And thus they only have one inventory account. That account which houses their inventory, the products that they will be selling in order to earn a profit to run the rest of their business. In Accounting 2020, it'll be a bit different. You'll have three inventory accounts. Raw materials, those are products which a factory brings in order to convert them into finished products. Work in process, those products which are not finished at the end of the period, and so we have to allocate some cost to them. And then the finished goods, those goods which are 100% finished and ready to be sold to wholesalers and retailers. We're going to be looking at first in this video recording purchases, and in the next video recording the sales in the general journal. By Chapter 6, we're going to be looking at how do we calculate the costs of the good we sold and what are the costs that remain in inventory. And there are some special allocation processes that we will be discovering and learning. It'll be a fun few chapters. So in order to look at how we record purchases in the general journal, I've set up this problem of Roadrunner's Roost, and they've started selling study workbooks. And they purchased their first study workbooks, 100 of them from Cooglin Publishing. And Cooglin Publishing allowed them to charge it, so we say they purchased them on account. And the workbooks cost us, Roadrunner's Roost, $25 each. And I've set up this invoice below. And the invoice, I made this in Excel. It was from a template, so if you're ever starting your own business, Excel has some wonderful templates. We had the petty cash template. Now we have a purchase invoice template, sales invoice templates. And so on this invoice, you can see the company, Cooglin Publishing, the date that the invoice was issued, September 1st, 2015, an invoice number, the customer number, Roadrunner's Roost, who we shipped it to, the salesperson at Cooglin Publishing was C. Cooglin. Cooglin Publishing shipped it via UPS, and they shipped it under the shipping terms FOB destination. Now, do you remember what FOB destination is? FOB destination means that the buyer takes ownership at the point of when it reaches our store. So the seller has paid for the shipping. Freight on board, FOB, the seller has paid for the shipping until it reached its destination. So we, Roadrunner's Roost, don't take ownership or pay costs until it gets to us. What is the other shipping term that it could have been? FOB shipping point, freight on board or free on board shipping point. What does that mean? FOB shipping point means that the buyer takes ownership. The buyer pays for the shipping at the point it leaves the factory or the shipping dock. And you'll be negotiating this with your companies if you are in either type of a role. So it also says that the books were delivered on the same day as the invoice was issued. And then we come to payment terms, and those are kind of special as well. And payment terms are the negotiated price and the negotiated terms of which we will be paying this company. And these terms say that if we pay within 10 days, we will get a 2% discount. 2% discount if paid within 10 days, but it is net 30 or absolutely due in 30 days. So 2% discount if paid within 10 days, absolutely due within 30. And these can vary from company to company. The due date of the payment is October 1st, 2015. So it's 30 days out. Also on the invoice, we see that we bought 100 accounting workbooks at $25 a piece for a total cost of $2,500. So we are Roadrunner's Roost. We get this invoice and we have to enter into our books the fact that we made this purchase. So the debit will go to the merchandise inventory account. This is merchandise that we plan on reselling, merchandise inventory for the $2,500, the full amount that we owe to to Kugelin Publishing. And since it's on account, it's an account payable. If we had paid cash for it, which we did not, remember it's on account, we would have simply credited the cash account to show the payment had been made. But as often as we can, we love to charge things on account because it gives us that $2,500 to work with for those 30 days, and that increases our cash flow possibilities. So now that we've recorded the merchandise inventory and recorded that it is on account, we now need to discuss what happens if some of those workbooks that we got did not meet our specifications, that anybody would want to buy them from us. Then we have to look at returning those workbooks. So what would be the journal entry to record those workbooks that are going back to Kugelin Publishing? Well, in the perpetual method, it's nice and easy. We keep it nice and clean. Everything flows through inventory. If we make purchases, we record the purchases in merchandise inventory. If we return the purchases, we take it out of merchandise inventory. We simultaneously, if we've purchased it, we record the account payable. If we send stuff back, we take it out of the accounts payable. So here is the journal entry and the corresponding T accounts. You can see merchandise inventory when we bought it, debited $2,500. Merchandise inventory when we sent it back, credited $2,500. It gave us a balance of $2,250 in the merchandise inventory. This is how much cost we have tied up in our merchandise inventory. Also, we show that we had a $2,500 charge to Kugelin Publishing. We now owe them $250 less because we sent $250 worth of merchandise back. It gives us a balance in the accounts payable to Kugelin Publishing of $2,250, the amount that we still owe on our bill. So everything flowed through inventory. Now, if we had purchased those books and we had sent some back and it comes time to pay the bill, what happens? How do we record if we take advantage of that 2% discount? Well, here's the original journal entries, the merchandise inventory, accounts payable, sending the products back, reducing accounts payable, reducing inventory. And then to record the payment, we had determined that we had $2,250 still owed on our accounts payable after sending back the merchandise. So we need to make sure that we take that entire bill off our books. And in order to do so, we are going to have to debit the entire $2,250 out of our accounts payable so that we show a zero balance at the time we make the payment. However, that's not how much cash we have to send, is it? No, if we take a 2% discount, and it's right here, 2% times the $2,250 we owe, that means we get a discount of $45. So in order to reflect how much cash we have to send out the door, we are going to go ahead and reduce the cost that is held in our inventory by $45, and we are going to only need to send to Kugelin Publishing $2,205. That's the only amount of cash that has to go out the door. Get rid of that accounts payable bill of $2,250. So again, that discount flowed through inventory. This will show that the cost of that inventory was really only $2,205. We had originally purchased it for $2,500, sent $250 back, but got a discount of $45. The cost tied up in our inventory was $2,205. That is how much cash had to go out the door to pay for it. And even though our original account payable was $2,500, we reflected all that we had actually had to pay through the cash, through the inventory, and then reducing our bill to zero. Again, everything flowed through inventory. In part 2, video 2, I'm going to be discussing when Roadrunners Roost begins selling those workbooks and how we deal with that. And so under the perpetual method, recording purchases only took one journal entry when we recorded the purchase. Under the perpetual method, sales are going to require 2 journal entries to record the sale.